92,000 jobs gone. The U.S. economy didn't just slow down in February, it reversed. Non-farm payrolls contracted by 92,000, the worst single-month loss since late 2020. Wall Street expected a gain of 50,000. They were off by 142,000 jobs. And it gets worse. December was just revised into negative territory. That means payrolls contracted in 2 of the last 3 months. The unemployment rate jumped to 4.4%. And the federal government has shed 330,000 jobs, 11% of the entire federal workforce since October 2024. Here's the part that should alarm you. This isn't just one bad month. The underlying data reveals a labor market that has been quietly breaking for over a year. Let me walk you through exactly what happened, what caused it, and where this is heading. Let me give you the numbers, because they tell a story that nobody on cable news is putting together. The Bureau of Labor Statistics released the February 2026 Employment Situation Report on March 6th. The Dow Jones Consensus was a gain of 50,000. Reuters polled 59,000. FactSet projected 60,000. The actual number? Negative 92,000. That's not a miss. That's a catastrophe. Private payrolls shed 86,000 jobs. Government dropped another 6,000. And here's what makes this worse than one bad print. Full year 2025 produced only 181,000 total jobs. Kansas City Fed President Jeff Schmid called it the slowest annual pace outside a recession on record. Let me put that in perspective. In a healthy economy, the U.S. adds roughly 200,000 jobs per month. In all of 2025, we barely created what one good month should have delivered. The 6-month trailing average has hovered near zero since September 2025. The labor market didn't collapse overnight. It's been bleeding out in slow motion. Let me walk you through exactly what hit in February, because it wasn't just one thing, it was everything, all at once. Start with healthcare, negative 28,000 jobs. A strike by 31,000 Kaiser Permanente workers in California and Hawaii landed right on the BLS survey reference week. When workers are on strike during the survey window, they don't get counted as employed. That single event wiped 28,000 jobs off the headline number. Leisure and hospitality, negative 27,000. Restaurants and bars accounted for nearly all of the decline. A severe cold wave swept through the country in early February, freezing out the service sector. Manufacturing, negative 12,000. That sector has now lost roughly 100,000 jobs since January 2025. 100,000 in just over a year. Construction, negative 11,000. That came right after a 48,000 gain in January. The cold wave crushed outdoor work. Information sector, negative 11,000. Transportation and warehousing, negative 11,000. The only major sector with meaningful gains? Financial activities, plus 10,000. One bright spot in a sea of red. Now here's where it gets dark. The February report also revised December 2025 payrolls from a gain of 48,000 down to negative 17,000. That's a swing of negative 65,000 jobs. December went from a modest gain to an outright contraction. January was nudged down from 130,000 to 126,000. Total revision across both months? Negative 69,000. And this pattern isn't new. The BLS annual benchmark revision showed that 911,000 fewer jobs were created in the year ending March 2025 than originally reported. 911,000 jobs that were never real. Sound familiar? Here's what most people don't realize. The February number is bad, but the mechanism behind it is worse. There are 3 forces converging on the American labor market right now, and none of them are temporary. Force number 1, the federal workforce, gutting. The BLS confirmed that federal government employment has fallen by 330,000, or 11%, since its October 2024 peak. Federal employment now sits at its lowest level since 1966. That's not a typo. 1966, the Department of Government Efficiency, DOGE, drove most of these cuts. The deferred resignation program saw roughly 75,000 workers accept buyouts. Mass firings of probationary employees followed. Then agency-level reduction in force plans hit. The most affected agencies? Department of Defense, down 61,600. Veterans Affairs, down 48,000. Treasury and the IRS, down 31,600. Agriculture, down 21,600. USAID was effectively eliminated. And here's the devastating detail. Employees with 30 or more years of experience saw a 33.2% net decrease. That's institutional knowledge, gone. Decades of expertise, erased. DOGE was quietly dissolved in late 2025. Elon Musk departed in May, later calling the initiative only a little bit successful. And critically, DOGE had no measurable effect on federal spending. Outlays actually increased roughly 6% in 2025. The deficit grew by nearly $2 trillion from October 2024 to August 2025, because the vast majority of federal spending goes to entitlement programs that workforce cuts don't touch. Here's the part that should terrify you. The Washington Post reported on March 9th that the administration is now quietly ramping up hiring. OPM Director Scott Kupor acknowledged, and I want you to hear this, quote, "We probably have some skills that we now need to hire back. Sometimes you over-restructure," end quote. They fired 330,000 people, destroyed a generation of institutional expertise, saved nothing on the deficit, and now they're hiring again. Force number 2, AI-driven corporate layoffs. This is no longer theoretical. Block, formerly Square, cut 4,000 employees, 40% of its workforce. CEO Jack Dorsey stated that intelligence tools have changed what it means to build and run a company. Atlassian eliminated 1,600 jobs, 10% of its staff, citing technology shifts. Amazon cut 16,000 corporate roles. Morgan Stanley shed 2,500. Dow Chemical announced 4,500 cuts linked to automation. Reports suggest Meta may cut over 20% of its staff to fund $135 billion in AI capital expenditure. The Challenger job cuts report found 12,304 AI-attributed layoffs in just the first 2 months of 2026. And here's the number that should keep you up at night. Announced hiring plans for January through February. 2026 totaled just 18,061. The lowest since 2010, down 56% from the same period in 2025. Companies are cutting, and they are not replacing. Force number 3, external shocks. Tariff policy remains disruptive. The Supreme Court struck down the IEEPA-based tariffs on February 20th, but the administration reimposed a 10% global tariff under Section 122. The Yale Budget Lab estimates remaining tariffs will push unemployment 0.3 of a percentage point higher by year end. Meanwhile, U.S. and Israeli military operations against Iran, beginning in late February, closed the Strait of Hormuz. Brent crude surged past $100 per barrel. U.S. gas prices jumped over 20%. 3 forces: federal job destruction, AI displacement, and an energy shock nobody saw coming, all landing on a labor market that was already running on fumes. So what does this mean? Let's talk about what the data is actually telling us. The unemployment rate hit 4.4% in February, up from 4.3% in January, up from 3.7% at its 2024 low. That's a 0.7 of a point increase, a magnitude that historically triggers recession indicators like the SOM rule. Approximately 7.6 million Americans are now unemployed. Long-term unemployment, that's people out of work for 27 weeks or more, rose to 1.9 million, up from 1.5 million a year ago. Average unemployment duration hit 25.7 weeks, the longest since December 2021. The labor force participation rate fell to 62%, the lowest since December 2021. People aren't just losing jobs, they're leaving the labor force entirely. Average hourly earnings rose 0.4% month over month, 3.8% year over year. both above expectations. Wages are still climbing, even as hiring collapses. That's the textbook definition of stagflation pressure. Prices going up, jobs going down, and the Fed can't fix both at the same time. Core PCE inflation stood at 3.1% in January, well above the 2% target. The March 17th FOMC meeting carries a 99.2% probability of no rate change. The Fed is frozen. Mark Zandi of Moody's Analytics put it bluntly: businesses don't know what's going to happen next. They're going to invest less. They're going to hire less. And here's what that creates: a self-reinforcing cycle. Companies freeze hiring because of uncertainty. Workers stop spending because they can't find jobs. Demand falls. Companies cut more. Repeat. There are only two scenarios right now. Scenario 1, the rebound. The Kaiser Permanente strike resolved. February 23rd. Weather effects are temporary. March payrolls bounce back with 100,000 plus gain. Initial jobless claims remain low. They were just 213,000 for the week ending March 7th. The January JOLTS report showed 6.95 million job openings, a bounce from December's low. The prime age employment to population ratio is holding at 80.7%, above the 2019 average. If the external shocks stabilize, if tariff uncertainty fades, if the energy shock resolves, the floor holds. The economy muddles through at stall speed. No recession, no recovery, just a long, slow grind. Scenario 2, the break. The AI layoff wave accelerates. The Strait of Hormuz stays closed. Oil pushes past $120. Tariff costs cascade through supply chains. The 330,000 federal jobs don't come back fast enough. Consumer confidence, already cratering, collapses further. And the Fed, stuck between 3% inflation and a dying labor market, has no tools left to deploy. Unemployment crosses 5% by summer, and the self-reinforcing cycle takes hold. 92,000 jobs, gone in a single month. 330,000 federal positions eliminated in 16 months. December revised into contraction. Manufacturing bleeding 100,000 jobs in a year. AI replacing workers faster than the economy can absorb them. Hiring plans at their lowest level in 16 years. And the people who engineered the largest peacetime workforce, cut on record, are now quietly posting job listings. What happens over the next 90 days will determine whether February 2026 was a blip or the month America's labor market broke.